Joining us now on location to discuss the latest in the grain and livestock markets is Kyle Bumsted. Kyle, great to see you.
Good to see you too, sir.
Let's start on the row crop side of things and we'll pivot over to cattle. Row crops, things are sideways. In your opinion here, how long might that last?
You know, I think we could see us stay in this sideways range here for probably the next 4 to 6 weeks potentially. You know, the old timers always say the low is around Columbus Day because that's when we had to have all of our slips into the FSA office. So that's typically when the market bottom. But I do kind of see us trading sideways to maybe grinding lower here. We've held support recently around the 470 area, but if we do violate that area in the corn complex, we could see us make a quick turn down to that 450, maybe 440. And then after you start breaking 440, then you're looking at 430 and 420 as your major support areas. And then we've got to go way back on the charts here to find the major support, and then it gets kind of a gray area from a technical standpoint.
You're going down a path I don't think our listeners and viewers want to hear today.
That's right, that's right. Well, one of the things that we need to kind of keep in consideration here is we're pulling the combines out of the shed here. What's the amount of carry, and is the market paying me to store grain out there to that July time frame or May time frame or March time frame? And I was checking some option prices here on the way in this morning, and option volatility is very cheap right now. So if you want to maybe go ahead and part with some of those bushels here off the combine here, stop some interest, because interest is a big one this year, it may be economical for a producer to look at some of those options out there, that March, May, July time frame, as cheap as they're getting right now. So that may be something a person takes a look at. There is some carry in the market, but it's not really bearish. It's more of a neutral type carry right now.
Talk to me more about those options. For a producer watching today has never gone into that realm, what should they know ahead of maybe looking deeper into that?
Well, if you're looking into the options and you've gotten rid of the corn or beans or whatever, I'd be looking at some call options, and I'd probably be looking to be a buyer of those options since volatility is cheap. I wouldn't be looking to sell them here unless you have bushels in the bin that are unpriced, and you know the risk associated with these, because selling an option carries some risk with it as far as margin and things like that. So if you're buying an option, you know where you're at, you know how much you stand to lose, and you know what there is to gain, and you kind of get a better break-even point figured out when you own that option.
All right, one more question on the row crops, and then we'll get into the livestock side. Any potential news that could swing us higher? You only talked about one direction, given your thoughts on the chart support.
Well, yeah, there is. As a matter of fact, you know, we don't know how big this crop is, corn or soybeans. I mean, flew into Grand Island a couple days ago, and you could look down and see folks were combining dryland soybeans. Don't know what the yield is there. We obviously don't know what the yield is going to be on corn yet either. That's kind of a moving target at this point. A lot of choppers running up there in the sand hills, and a lot of cutters everywhere going, you know, western Iowa and western Kansas, all over in cattle country, they're taking corn off. And, we don't know the size of the crop yet, but we could also see our export demand pick up as well too, and that's what we ultimately need to see happen, is our export demand. We need to get some more demand sparked here for U.S. grain.
All right, now over to the livestock, specifically on cattle. I'll just toss it to you. Give us your overview where you see the live and feeder cattle markets at as we speak today.
As we speak today, we've been sideways for several weeks in both these feeders and live cattle as we go here. Now, live cattle have been the biggest one that have been sideways for several weeks, and I really don't see us breaking out of this trading range in the October contract from that 177.5 to 183.5 area. I think we're going to maybe stagnate in here for a while. Now, if we break those lows of 177.5 from a technical standpoint, we could see a quick $10 sell-off down to the mid-160s. Now, I know that's not what folks want to hear, but up front here, we do have some cattle around us here. We do have a little bit of supply here, short term, but long term, looking at this live cattle complex, I would not be surprised if we make some kind of a all-time high or cycle high maybe the first half of next year. And that news is probably going to come, obviously, because we have lower numbers out there. We're probably going to start retaining some heifers as well. And then we get some snowstorms or something coming in this winter. You're probably going to get some euphoria, and it could jack this market up pretty good. And that's where a producer needs to look at some of those downside protection areas.
You and I were talking about the cost of keeping cattle right now, I guess, in the feed yard and elsewhere. Talk to me through some of the calculations you've been making right now when it comes to trying to figure out how economical is this truly.
That's a good question. Actually, a couple days ago, worked through this with some producers and some other folks in my industry. We use the October feeder cattle board and the June live cattle board, and the producers we were talking about were based in western Kansas, which would be southwest Nebraska as well, kind of in that general area. And we used the Western Kansas Cash Corn Index, and that was priced at 504 bushels. So we used 504 a bushel, we used the feeder cattle board price, and we used the June live cattle contract. And using around 8.5 to 8.75% interest, taking a 1,450 pound steer out, you're looking at about a 210 break even. So that's where it looks to me very imperative if you get some of these rallies here later this year, first part of next year, where you need to look at that downside protection, because we're handling a lot more dollars and our margin hasn't increased as far as profitability.
Yeah, I'm glad you brought that up. I think if you're not necessarily in the cattle business, not working in those numbers day to day, you can look at these prices and think, wow, these guys must be making money hand over foot right now.
That's right. That's right. Well, and you see like new contract highs in the feeder cattle board this week, and you've got live cattle trading at all-time highs as well. Now the cash market this week has been, the bids are very early in this week so far, but it wouldn't surprise me if cash is steady to maybe a little bit lower when we finally get the calculation here at the end of the week.
China continues to come up in various conversations about a lot of things, frankly, but when it comes to the markets and specifically the livestock front with cattle, what are you watching on that front? What concerns you? What are you keeping an eye on?
I'm kind of keeping an eye on their demographic. Last year, China imported $2 billion worth of U.S. beef. Now, I haven't gone back and adjusted for inflation and tonnage and things like that, but their number one consumer of beef in that country is the single male population from about that age 20 to 35. So they're the ones over there that are consuming the beef. But also you need to look at their economy as well. They've done some things over there recently. They've cut interest rates and tried to get folks stimulate their economy by cutting margins and things like that, trying to get folks to invest in their stock market and things like that. So that's one economy we really have to watch. And if we do see some fallout, it could potentially trickle over here into the U.S. economy. Now you look at the U.S. economy, we're sitting here with all-time record high credit card debt. So, consumption of beef is great. We're moving it. People love it. But we've got some things out there that are still lurking out there kind of in the weeds, so to speak.
On last week's program, we spent quite a bit of time talking about herd rebuilding. And one of the things that comes into play there is interest rates. Those keep ticking higher at this point. What impact would that have on a producer's mindset whether to keep your heifers or not?
That's the main driver right there is, are we going to keep them or are we going to part with them? And when you look at the interest rates, I know some ranching operations are looking at 10 to 11% interest here this year, and if that rate continues to keep going up, then you're probably going to see more heifers get placed in the feed yard as opposed to put back in the herd. So I do think that once those interest rates kind of, we start to, if we don't raise rates anymore and we start to maybe work down, you're probably going to see a little bit more heifer retention start to take place.